All right, all right, all right.
Here comes the money.
Here we go. Money talk.
Here comes the money. Money, 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 money.
Dollar, dollar. Dollar.
All right. Welcome back, or welcome, or whatever you're doing. You've landed here, and I hope you'll spend a couple of minutes with me, and I'll bring you up to speed on what I'm looking at. First thing I'm looking at is history. I want to see what happened before in order to understand what may happen in the future. And I think it applies to markets. It's not just world history or history in general that it applies to. So what do we have? Actually, we have the Dow, because the Dow has the most data. They go all the way back to 1903, and these are yearly bars, or yearly candles, years at a time. And what do we see? We see a meteoric rise in the Dow, but I think the underpinnings are not that strong. If we look at the anchored momentum, which is my go-to indicator, it's a situation where he had a real strong run to the upside here, then he spent years going down. But it's divergence of sorts, because the Dow continued to go up. You can't really see with the price action here, not until around 1982 or so, and then the market really took off. And that's what's showing here. It really cranked to the upside. Culminated in 1999 or 2000. Then we had the bear market, 2000. That's what this is representing here. That was a pretty significant bear market, and yet it doesn't look like much of anything in comparison to what preceded afterwards. Here's the financial crisis of 2008. And how terrible that was at the time. And once again, it doesn't look that bad in comparison. And after that, the market just took off. And up and up and up and up went. As you can see at the top, where we are now, it's outside the channel. So that's a pretty good sign that it's going to come back in. Where does it come back in? Well, does it keep going? Interestingly enough, this long tail down here reached down to the mean on the adaptive trend flow. All the way down, then all the way back. That's COVID. It's just amazing to look at what the tail did. Coming all the way down to touch the mean, and then bounce and take off. So it's hard to say exactly what's going to happen, but at the same time, to have such a meteoric rise and have the anchor momentum showing not necessarily a meteoric rise, it's showing divergence. It's showing that we could be going down quite a bit. It's quite a balancing act that the powers that be have been doing, keeping the market going up like this. It would have been a lot healthier if the market came down at some point and established a base before it took off again. But the other thing is, what's interesting is that this is a straight out chart. I tend to do is log charts on longer term charts to see what it looks like. So I happen to put that together for you here. Let me go up. And we select the yearly log chart. May take a moment. It's got to assemble a lot of data. I'll tell you, Thinkorswim is awesome. I know there's a lot of other competitors out there, and people, whether it's TradingView or, I don't know, any number of other things, but I've been with Thinkorswim now for almost 20 years. Actually, it's been 20 years. So, I'm not changing. I mean, I've seen changes happen. Went from Tom Sosnoff and the crew at Thinkorswim to TD Ameritrade, and now with Charles Schwab. But Thinkorswim has survived all those years. I'm glad it has, because I really use it as a go-to package to do trading and such, investing. Okay, so what are we looking at now? We're looking at the same chart, but it's a log chart. So we're going all the way back to 1903, way back here, and you see a run up here. And you might say to yourself, well, what is that? That's the roaring 20s, roaring higher. And then all of a sudden, look at the collapse. I mean, that was a hell of a collapse. That's 1929, 1930 and on, the Great Depression. I mean, you had a run up, and then you have run down big time, and it went down lower. The low here goes all the way back to 1903, the low at 1903, which is pretty wild, and then start building again. And it's been building ever since. Well, that's what the log chart shows, which is kind of interesting. You had a lull here, and what did it do? Essentially consolidation. It had a hell of a run from like the end of World War II up into the 60s. My dad had a company that was bigger than ADP at the time in the 60s, and he went back to the market for more money, and the money wasn't there. It was right around here where the market tanked. There wasn't any money to be had, so he had to fold the tent, had to do something else, had a family to raise, had to basically pay the bills. So you do what you have to. When times are tough, you gotta buck up and friggin' do what you have to. So, and then we took off again, right around when President Reagan was in office. People might remember the 80s. The 80s were flying, and then the 90s were flying. And the market really took off, and it topped out 1999. Like Prince said, we're going to party like it's 1999. Well, there was a party in 1999, but 2000 came around. Some of you may remember, some of you may not have been around in 2000. But we had a bear market, and it came down. Where did it come down to? It basically almost touched the mean again before it took off. Then we had the financial crisis of 2008 again, and it came down and touched the mean. And it even dipped down. It's something it didn't do since way back here in the bear market of 74. Dipped down into the first standard deviation. And you have the second standard deviation. What you really have is you have the mean, first standard deviation, second standard deviation, and third standard deviation. You go beyond the third standard deviation, you're pretty much guaranteed that you're going to bounce and run the other way. But you don't see that happening on a log chart. It's just moving up, up and away, up and away. Until now, what happened? Hit the top of the channel. It would be healthy if it reversed. It would be devastating. People lose a lot of money. I don't want to see that happen. But you got to look at history and what history's done. I mean, my God. It's incredible. So that's the Dow from 1903 to now. 122 years of data. Pretty impressive. And I thank Charles Schwab and Thinkorswim. I thank TD Ameritrade, and most of all, I thank Tom Sosnoff and the original crew at Thinkorswim for putting out a package that I could use to look at something like this. So let's burrow in and see what's going on with today. It's the weekend. It's Sunday. It's currently 1 o'clock in the morning, Monday morning, April 7th. Let's go to, we look at years. Now let's look at months. That's the Dow. Actually, no. I have it set up so it picked up the NQ, which is what I want to look at. I can't look at MNQ, the micro, because it doesn't have enough data. You got to look at NQ, which is the mini, and we'll take a look, see what's going on. First things first, we're looking at a pretty heavy correction, and I think it's bordering on being a bear market, if not already. I don't know what the percentages are and what the exact criteria are, but it just looks pretty horrendous right now. And what happened? Fib-wise, it came down on Friday to the 61.8, and it was kind of poised there. And then Friday sold off heavy, came down further. Sunday it opened up, it gapped down, and it came to sit right on the 78.6 roughly. And where does it go from here? Well, it could go to 100%. It could go to, which I'll dial in quickly. I don't want to spend a lot of time. I want to make these short so they can take a look, get a handle on things, and then go about what you have to do. 2 seconds. I gotta collect my thoughts. I'm in the wrong place, that's what it is. I'm gonna go into the fibs themselves. And what do I want to dial in? 88.6. It's sitting at 78.6. 88.6, which squeezes in between the 100 and the 78.6. It's at 16.883.48. And where are we at? We're actually past that. We're at 16.756.50. So what that means is this has not got extended hours going. So I'll click on extended hours since it's 1 o'clock in the morning. And all of a sudden, bam, we got a red candle. That's pretty heavy duty. We'll take the 78.6 off because it's past that. Or the 88.6, I'm sorry. 88.6 will take off. We can take off the 78.6. Just take some of the lines away. End up having a lot of lines. There we go. So price came down last month, sat on the mean. It's just perched there. Could have bounced, but it didn't. It's going down. And that's what happened here. It went down substantially. And the month, it's just starting in certain ways. It's the 7th, so we got quite a bit of time. And what could happen, it could come down and bounce and leave a tail on the bottom. But right now, it's just selling. And that's what the volume's showing. The volume averages are showing. The buying volume average is drying up. It's just going down. And the selling is kind of just starting to take off. So we got to wait and see. So what comes at the 100%, which is 16,170 or 167? We get the channel coming up. Between the channel and that 100% fib, I'm thinking that that could be the place where it bounces. That doesn't mean that it's over. It just means that it comes down to a point where the buyers might sense the opportunity to come in and push things around the other direction a little bit. I think the selling is firmly in hand. Given the selling that we've had the last couple of days, I mean, it's really, you can see it's come down substantially. And then the question becomes at 100%, we draw a line backwards through history. We had resistance here and sold off pretty good after hitting that resistance, that 100% resistance, plot it backwards. And then we go further in history and go back, and we go back to a prior top. It hit this top, then it's been a year consolidating, correcting, whatever you want to call it. It came down for a year before it took off again. With this kind of fall, I mean, people are, I'm sure, prognosticating in all different sorts of ways about what's going to happen. And I'm not going to sit here and make predictions of any kind. But with this kind of fall, it could substantially come down further. And that's why I started drawing lines off of the Fibonacci's going backwards to see what kind of interactions there were. And the 127.2 was the base of whether you had this little correction here, come down, sit on that, and then start moving higher. Now the next one, the 161.8, which is at 12,284, bring that back. It hit this candle, it broke through, but what it didn't do, it didn't come back and test that breakthrough. That's not good. That's what my dad calls a touchback. It didn't touch back before it moved higher. So that's kind of like a naked virgin point of control in volume profile, except this is just a trend line off of a Fibonacci. But I still think that's a potential target at some point. And to think that it could go down to 12,000 and change is pretty, I guess you'd say scary. I mean, because that would be massive in terms of the effect it would have on everybody. But in any event, so I went to the 200% and I draw that all the way back to a point where it's another touchback situation. It broke through, didn't touch back, and kept moving. Then it came to the correction, and the correction didn't come down and touch. Missed an opportunity by relatively few points, and then it just moved higher from there. So that's kind of what's going on price-wise on a monthly chart. In terms of the volume averages, we already kind of touched on it, but the buying is drying up, and it looks like the selling is just starting to get going. So we shall see. But once again, the anchored momentum is showing. The red line, the fast line, has already cracked through the zero line and it's headed down. The green line, the slow line, is kind of curving to the downside. This is showing momentum is really in the bear's favor, coming down. And given everything that it's looking like on this chart, I don't know if the bears are even excited that much. This could be bad, and I don't want to sound like gloomy Gus here, pronouncing the end or so on and so forth or whatever. But the fact remains, it's going to do what it's going to do, and we shall see. Now, the VIX, the inverted VIX, is actually working on this chart, which is nice because it gives us a little extra insight into the kind of similarities between the anchored momentum and the inverted VIX. And basically, what it's looking like, it's looking grim. The gold line here, or the orange line, or the yellow line, is basically showing that, things are headed down pretty substantially. Now, what's interesting is going back on the inverted VIX to another time when we had a similar kind of situation. What do we have? We had COVID. This was COVID here, which looks like nothing. Looks like a drop in the bucket. But at the time, it was pretty hairy duty. I mean, so much so that the government ended up spinning out like $5 trillion to ensure that the economy kept going. But it's kind of like giving a heroin addict a friggin' serious speedball. It's not necessarily what you really want to do, but it's not up to me. But all I'm looking at is history here. I'm looking at something that looks somewhat similar. So maybe it ends up being something like this, just on a larger scale. It's possible. It remains to be seen. But we shall see what we shall see. I mean, the nice thing about the inverted VIX is that it has a Bollinger Band applied to it. So basically you can see areas of volatility or not volatility. Like there's not a lot of volatility going on all along here. and it's just cruising along, and then all of a sudden the volatility kicks in, and you see the Bollinger Bands expand out, and you see the VIX itself, the inverted VIX itself, outside the lower Bollinger Band, which in some ways was a huge opportunity. Now, if you could have dealt with the COVID situation and remained level-headed about it, you could have made a lot of money, because of that freaking thing just bounced right back and took off big time. I don't know if that's going to happen this time. It's a different situation. So we shall see. But the parallel is, once again, the volatility constricted the inverted VIX, and now the inverted VIX has burst out the bottom side and is pointed down substantially. And we might just need to wait for a bounce, and then it takes off, and correspondingly price may take off as well. So that's the upside. Just move this over here for a sec. Okay. So that's the long-term view. We had the very, very long-term view. We had the historical view. Now we have the long-term view of NQ. So we're looking at the NASDAQ. It's not the same as the Dow, but it's certainly one of the mainstays in terms of the averages. You have the Dow, the S&P, and you have the NASDAQ. In a lot of ways, to me, it seems that the NASDAQ is going to become the preeminent average in certain ways, because it's all about technology. I mean, there's other small facets of things, but it's really become recognized as the technological average. It's all about technology. And that's what everything's going forward. I mean, we've got the potential of having cars that drive themselves, robots. I mean, we have AI now. I mean, it's just incredible how technology is just exploding all over the place. So we shall see what we shall see. Let's go a little further in. We'll go to a daily chart. And the daily's a little bit different from the standpoint. Well, let me see for a sec. Hold on. But it looks different because I don't have the adaptive trend flow going on. I didn't really like it, so I took it off. It's not as clean because daily chart is moving a little bit differently than the monthly, so it's kind of chopping up and down. But it does show one thing. This was the top, and this was the lower high. And lower highs are brutal. And down it comes until you get a bounce. That's what I'm talking about, bounces. It bounced up, but it got held in by the 233 EMA, which is an exponential moving average. And 233 is a fib number. And I know I keep saying, everybody talks about a 200. 200. That 200 doesn't mean anything. 233 means something, and that's what this chart shows. It broke down below, came up, tested the underside of the 233, failed, and down it comes. Plunge. Excuse me. We have fibs applied, and we have confluence in terms of fibs, but price doesn't care. I mean, you can get temporary support, but it's trying to find supply. It's trying to find an area where buyers are going to come in and buy. And it looks like a little bit that today, let me make sure that it's today. Yes, we have extended hours on. So this trading action is basically since 6 o'clock this evening, or yesterday, it's the evening. And what did it do? It came down. It was looking pretty hairy, because this was kind of a line in the sand for me. I mean, I'm thinking to myself, if it fails here, it's got a lot lower to go. And right now, it's kind of half and half. The bears pushed it down big time, then the buyers came in and pushed it back up as best they could, and just got it back over the 161.8. Now you might say to yourself, well, what's below that? I don't know if we even want to look what's below that, because this is pretty damn hairy. But you know what? Let's look below. There you go. You got a 423.6 at basically 15,000. Given the look of the charts in terms of the volume, in terms of the anchor momentum, in terms of the inverted VIX, I don't think that's out of the realm of possibilities. I would much prefer to see this bounce and all of a sudden do, you know, a V shape where it just crashes down and then rips right back to the upside. I would much rather see that, because there would be a lot less people hurt. There's enough people hurt right now, and that's what really sucks. But you gotta live. You gotta basically buck up, deal with your responsibilities, and just be the best you can be, and just keep going. No matter what life throws at you. I don't want to get on the soapbox, be all philosophical or whatever, but that's what it comes down to. You do the best you can with what you got. So 423.6 is a potential stop. But right now, the 161.8 is holding. And what's really going to come down to is the New York session starts at 9:30. All those overnight orders come flooding in. And it's going to be a situation where people are freaking out. They're going to sell more, or they're going to start buying. Takes a lot of strength to face a serious downturn like this and start buying. But those are the people that make fortunes. So, anyway, that's the daily chart. Now, if we take the extended hours out for a moment, see how different it looks. All of a sudden, it's pretty interesting. You got gaps. And to me, gaps they're basically opportunities. Because when you have a gap down like this, it tends to want to fill the gap. Maybe only 50% of the gap. It doesn't have to fill the whole gap, but it can fill 50%. In any event, it gives you something to aim for. So we're looking at 18.5 roughly, and we're currently at 16.7, 16.8. And where's this? This is down to 17.5, and that's without the market hours. So what do we got? I'm gonna make sense of this quick. I think I'm getting screwed up. Let me see. Let me go back to extended hours showing. Yeah, that's showing 16,790 roughly. 16,790. And we get bogged down in minutia. We're currently at 17 and a half minutes that have been yakking away. Don't keep this short. Take the extended hours off. It came down as low as 17,522. And we're currently at 16,777. So it's up about 100 or so points from the bottom this evening. Let's go a little further in. First I'm going to do, I'm going to get rid of extended hour. Put extended hours back on so we can look at both sides of a 30-minute, which is something that I didn't basically show in prior videos. I just went with the monthly, the daily, and a 5-minute. It's kind of a big jump between a daily and a 5-minute. So here's a 30-minute, which is kind of in between the daily and the 5-minute. And what's it showing us? First of all, it's showing a gap. Here it opened, gap down, and plunged. And you see the tails, the little tails on these little candles. Those are buyers coming in, trying to buy and bid back up price, get it going the other way. Whoever those buyers are, I salute them. They're courageous. Stand in the face of serious sell-off. And what happened? We got a little bit of a higher low here. So that's actually good. And price is responding. So we had a higher low from this low. And it's right around what was pretty significant support, I guess, in certain ways, even though it went past the 161.8. Now we're dealing with the 261.8. Shorter term, this is the 161.8 is a longer term than the 261.8 fib-wise. But it's right, price is right there right now, 1 o'clock in the morning. Now 1 o'clock in the morning, what do you see? You don't see much in the way of volume. And without having significant volume, you're not going to do much. Although there are times when you can manipulate the situation when there's low volume. But maybe it's my bias. I much prefer having a lot of volume going on. Because then I know you got buyers and sellers all over the place, as opposed to just having, like an overnight session. This is right now. It's probably the Asian session. And around 3 o'clock or so, the European session kicks in. And at 9:30, you get New York opening up. And that's when the fireworks happen. So we shall see what we shall see. And what is volume showing? It's just showing Friday some serious volume going on. Substantial. Compared to prior, when it's substantial initially that I was talking about, when the overnight orders come flooding in and you get huge volumes first thing in the morning in New York. Well, this situation is more along the lines of serious volumes at different times. This is 9:30 and this is subsequently, which is different than these situations where it slopes off quickly. They catch up with the overnight orders and then the market goes whichever way it's going to go. Friday was a little different. You had substantial volumes going on before the market even opened in New York. Now what time is this big? 6 o'clock. 6 o'clock, you had a big friggin' dump of selling going on. And so you had subsequent buying kicking in. And what were they doing? You had the big dump here. They're trying to turn it. And then they lost control. The bears just took over. And down it came. This is a little different situation. It gapped down below the channel into the Fibonacci supports. And it basically caught itself, whoever caught it, and basically started working it higher. And then you got a higher low, hopefully off you go. We shall see. In terms of the anchored momentum, well, basically it's not looking so good. I mean, it's working its way higher. The red line, the fast line, is working its way higher. And the slow line, the green line, is working its way higher. But the question is, did they crack the zero line? I don't know that. I don't know. There's still a lot of work to be done. And that's the thing. Price can fall, free fall, fast, make a lot of money for certain people that know how to work that. But in terms of the long-term view, it takes a long time to build structure back to the upside. So something that can take a week or two to fall precipitously could take months of work to basically build price back up to where it started off again. So I would say to people out there who find themselves underwater right now and not in a position to sell, just hold tight, and hopefully the market keeps working higher and it doesn't go lower. But let's go to the 5 minute. Okay, 5 minute. There's a lot going on in the chart, but most of it has to do with, actually, what it has to do with is the fibs and I have lines on here, colored lines, which is actually the volume profile. And I have to shout out to Snoopy Doopy, which is a great handle, Snoopy Doopy, because Snoopy Doopy has helped me basically take some wacky ideas that I had and basically some of his own ideas and put together a volume profile that's really cool. And why is it cool? Because it accounts for naked virgin point of control. It accounts for extending out the current point of control in high value area, low value area, or high value node, low value node into the next period. So you get an interesting kind of situation going. Unfortunately, I can't get rid of, I mean, I could delete the fibs, but I don't want to because it took a lot of time for me to draw them to where they needed to be. So what happens is the color of the volume profile is really all you're looking at in terms of, not all you're looking at, but just provides the ability to look at the volume profile as opposed to the fibs, which is interesting because then you get confluence once again. So looking at the situation as it stands, and once again, like I said, different videos in the past, like looking at candles when they almost make a line as opposed to the individual candle action. So you zoom back out, like I have a 5-day, 5-minute up here. You zoom out enough, and that's what it kind of looks like, it's a line. At least it does to me. And what are we looking at? Well, we're looking at a situation where things are going down. But once again, like we looked in the 30-minute, you have a situation where it dropped down significantly with the open at 6 o'clock last evening, or morning. And now you have a higher low, and it's trying to work off of that. So if we zoom in, like I'll zoom in Friday and this evening into this morning. So we take a little bit more of a zoom in, and what are we looking at? We're looking at confluence. You have the volume profile, you have the low value area or low value node, and you have the high value area, the high value node. And it's hitting resistance right there, right now. It did crack it prior, going back earlier, but it's too weak, down it came. Now, on a 5-minute chart, you can spare yourself a lot of angst if you just look up at the 233 exponential moving average. That thing is red, it's just coming down like it is. You gotta wait for that to turn green in order to even think about going long. Buying in. I mean, that's the simple way of looking at it. A lot of people like to get in on the action where it's just going up and down real tight. People use, 5-minute charts, 3-minute charts, 1-minute charts. Some packages even give you the ability to do second charts. Second in terms of 30 seconds, maybe 15. I don't know. I've never used it, but I just read about it. But here's the open this evening, and you can see the gap that it left. Now price has gotten up as far as just below where it gapped down to. So the question is, does it fill the gap? The course of the overnight here, we're coming up on 1:30 in the morning. Does it fill that gap? And it doesn't really have to fill this whole gap here, because the low here is where it really, is at. You got like 17.4 roughly, 17,400. And here it got down to 17,144. So you get about 250 points separating the gap. And then it could do a 50% fill and then go lower. It's hard to say. It could do 100% fill and go lower because it's coming up in resistance on the 233, and you got fibs and volume profile higher overhead. I don't know. The only other thing to look at, I could look at the volume once again, and the volume overnight here is nothing to speak of, not in comparison to the volume you have when the market's open in New York. And then the anchor momentum, there's nothing really to write home about here until it gaps down big time. Then you got a big drop, and it worked its way back up. And then you actually had the red line and the green line break over the zero line. That's when it took off a little bit. So if you interpret things right, and I'm not going to sit here and claim that I know how to read the charts exactly the way they need to be read, but I've spent enough time. I mean, just to have these indicators on the chart took me over 2,600 similar indicators. 2,600. It's kind of like Edison when he made the light bulb. I'm not comparing myself to Thomas Edison, but at the same time, it took him like 10,000 filaments to finally come across the right combination of whatever he was putting together that made a light bulb. So, anyway, but that's the anchor momentum, that's the volume, that's the price action. And the last thing is we'll throw in the volume on the volume profile. Hopefully it works. Like I said, Snoopy Doopy is the man. He did a good job. I really appreciate it. Show the volume histogram. Yes. Okay. So what do we got? We got a situation where it looks like some of the difficulty I had last time, or one of the videos when I tried to show volume profile, is the histogram was covering the whole chart. But I know that this is not the case on here because of the volume that's showing on the overnight here. And this is the volume from Friday. So some people may say like, well, this is volume down here and it's pointed upwards, you know, and it's fluctuating. But this is volume by time. See, it's tying into the time down here. And over time, that's what the volume looks like. When you do volume by price, when the volume ties into price over here, that's why you get the difference in the two volumes. But each one tells a story. And I have to dig up the documentation. I have it somewhere that basically goes into the different shapes that the volume profile will have, that the histogram will have. Like right now, it's like a D almost, even though it doesn't look like a D. You know, not like a D you would actually write, but it's kind of like that. And what that means is that it's roughly in balance. Now, it did take a huge gap down, but since then, it's been within a range that's kind of like a balance. And then you have the point of control in the middle here, because that's where the most transactions and the most volume is transpired. And then you have the high value node, the high value area up here, and you have the low value area and the low value node down here, and in between is the value area. And I gotta look up the value area again. So the next video, I'll have better information for you. I'll have the different shapes that the volume can take, and I'll have a definition of the value area for you. So that's pretty much it. That's a 5-minute chart. I've shown you pretty much everything that I can think of. And once again, I'm at 43 minutes. So if you made it this far, I thank you very much for hanging in there. And I want to wish anybody out there that happens to hear this all the very best with everything that's going on. And I certainly hope for everybody involved that the financial impact won't be that serious. It's, not that I want to get on a soapbox or anything, but it's been a situation where everything has been in the market. Everybody's money has been driven into the market because it was the only place where you can get a half-decent return. I mean, you can get 4% on a CD at a bank, but you can make a lot more than that in the market. And that's kind of the draw. That's the allure. But sometimes it's gambling. Sometimes it's not necessarily investing. It's gambling. And gambling doesn't usually end end well for anybody, unless you're really good at gambling. So if you're good at it, God bless. If you're not, I feel bad for you. So, all right, that's the world as I'm looking at it. And I'm going to sign out here. So whatever you're doing, I sure hope you're having a good time doing it. And if you're not having a good time, I sure hope it's not hitting you hard. But we'll just keep going forward. Just keep moving forward. Like Sylvester Stallone said in Rocky, just keep moving forward. And that's what I keep trying to do. And I hope you do too. All right. Good night.